Hi, I'm Tim Chubb, Chief Investment Officer here at Gerard.
And I'm Tom Miller, Director of Investment Strategy here at Gerard.
So when we were working on the client letter, we titled it, ultimately, No One Rings a Bell. Tongue-in-cheek, of course, America's 250th, our friend Ben Franklin down there, really with obviously the Liberty Bell and the like. It was a cool story. But at the end of the day, nobody rang a bell at the bottom of the market, at the end of March, and certainly nobody rang one recently. Now back at all-time highs. So a little bit of recalibration as we kind of go into the second half, but directionally, I think pretty consistent with how we thought the year would start.
Yeah, and I think our base case, when you go back to the beginning of the year, was that the economy would continue to be resilient. We were hoping for some disinflation in the second half of the year, but the AI super cycle would continue. I think for the most part, that's all been correct. That disinflation hopefully does start to set in with the Iranian conflict resolution, oil prices coming down, maybe memory prices coming down. We'll see the cyclicality here, but a lot of optimism. Just as much as the headlines can be pessimistic, I think there's a lot of reason for optimism here. But from an equity position, Tim, what are you thinking for the second half? Quality becomes more important?
Yeah, I think so. Really it's been a one-way train with estimate revisions on profits, across the last couple of quarters, especially, related to the AI build out and memory in particular. I do think the rate of that growth will start to slow a little bit. But that said, we've seen broadening of earnings growth really beyond just those companies start to accelerate, which is, a huge positive for the market. I think longer term, it's healthier. And it's been especially true with a lot of the companies, especially with the quality orientation that we have, that I think have been unfairly pegged as, sort of AI disintermediation, candidates. Many of these companies, like even the rails of, the financial system with Visa and MasterCard, and those who are, S&P Global and our debt rating agencies. Really, as we've gone through this last quarter's earnings season, we've seen them starting to monetize their AI investments and monetize that with their customers. And so I think, overall, that side of the market has just been a bit over, I should say, the market investors have been a little overly pessimistic and reactionary to that disintermediation, and it's a good place to start fishing from.
Yeah, and most of our clients have some allocation to fixed income. Fixed income's a little bit more attractive in one regard. At least base rates have stayed higher for longer, which keeps yields higher. But spreads are pretty tight. How are you feeling about spreads and spread product right now, given the backdrop?
Yeah, so as we look at fixed income asset classes, as Tom mentioned, the spread component is the compensation that an investor would be getting over and above, treasuries, and that compensation has not been great. And that's been reflective of fundamentals, though. Investment grade borrowers, even below investment grade borrowers, their balance sheets are in great shape. A lot of these businesses have been able to term out their debt, coming out of the post-global financial crisis era with very low interest rates. And so as profits have grown, interest coverage has been strong. And so although you're not getting rewarded for making, certainly an allocation in the sense of relative to treasuries in that respect, you're just flipping the coupon. It's kind of a carry environment where, given, like you said, that base rates are elevated. We've got 5% on the 30-year, 450 on the 10. Compared to the earnings yield in the S&P, that's not a bad starting place, especially if we start to see rate cuts start to get priced in perhaps in early next year.
Yeah, and I'm generally an optimist, and markets do deliver over the long term, but there are some risks out there. We have an untested Fed. Inflation has not settled, although we're optimistic it will. Rich valuations, depending upon how you measure them.
Yep.
And so, any thoughts on what should investors do for the second half of this year?
Yeah, I think it's a great time to take some profits and staying disciplined. Going back to the bell ringing, there's really impossible to be able to time it perfectly on the top and the bottom. And so, as we go through these, variations of enthusiasm around the AI build out, and then, overcorrecting on the downside, it's just important that you have that long view, have that discipline, taking profits along the way. And so overall, most of our clients have some modicum of fixed income exposure in the portfolio. We're, definitely managing the risk there pretty closely over the last couple of years. And I'd say the same is true within, the stock market. And if, you want to de-risk your portfolio, it's taking profits from stocks, but also some of the more recent winners and recycling into, perhaps not as exciting businesses, but those that have more compelling valuations.
And I'd be remiss if I didn't mention, and everyone will know from the commercials that we'll see here shortly, midterm elections, second half of this year, but staying the course really matters here. And I think, any thoughts on how markets have typically done in these election years?
Yeah, typically, if you look 12 months out after a midterm election, it's rare to find a stock market that's actually down, and not that, that past performance can be guaranteed, moving forward, but it is encouraging. And, hopefully we'll see, overall market that, kind of just rolls with it. Tends to be that way, and maybe a couple policies will get priced in by the market, ahead of time. But overall, I think at the end of the day, it's, again, important to have that long view and not get too overly worried about what may take place on a midterm election day.
So I guess the age-old question, is it timing the market or is it time in the market?
Time in the market, and for our private wealth clients, it's going back to that wealth plan and making sure that those sort of extremely pessimistic scenarios are already baked in the cake with your plan, and the same is true for our other clients. And so it's about being disciplined, staying patient, and not getting too high with the highs or lows with the low. Thank you so much for tuning into our Investment Current series for this quarter. Please tune in next quarter, and as always, reach out to your team at Gerard with any other questions you might have.